Good afternoon and welcome to FSE TV, the newly adapted TV digital broadcast and brand extension of the Financial Services Expo, which is coming to a city near you. Or is it? We just don't know at the moment. But what we do know is that since we haven't been able to build physical events, connecting the broker community with mortgage lenders, we have successfully become TV broadcasters of information direct to the advisor, embracing proper TV quality delivery rather than platforms like Zoom or Teams, which quite frankly has been done to death. It's staggering that we've since passed through winter and are now into the spring, all the while we've hibernated once again, this time in lockdown 3. And I only wish they could keep the hairdressers open so I didn't have to emerge from another hibernation with the hair of a hippie. I'm thrilled to have alongside me today Steve Sill of Bluestone Mortgages, who will be informing you of today's theme in more detail shortly. But before we hear from Steve, I'm going to explain what's happening on today's broadcast. We have a fully packed agenda today, and after Steve has discussed the theme, I'm thrilled to be joined on a panel debate with Steve, and I will be joined by industry larger-than-life personalities, Rob Jupp, Group CEO of Brightstar, and Steph Sharman, Head of Strategic Relationships of the Sesame Bank Group, where we will go in depth around the issues and the challenges in determining affordability, taking into consideration individual circumstances, utilising open banking and working across the industries. And following on from the panel debate, I will then be joined by Steve and Robert McKenney, who's the Director of Credit, Risk and Strategic Alliances from Equifax UK, where we will be discussing understanding complex consumer credit behaviour, offering the right products, using data to understand consumers, and support for those who are deemed unlendable. And finally, dare I say, saving the best to last, Reece Beddle, who's the Sales and Marketing Director of Bluestone Mortgages, will be on hand to present to you a broker solution for understanding the unlendables. And with that, I'd like to pass over to my co-host today, Steve Sill, who's the Managing Director of Bluestone Mortgages, who'd like to say a few warm words of welcome.
Thanks, James. And welcome to our audience. I'm Steve Sill, as James said, the Managing Director at Bluestone Mortgages. Firstly, thanks for taking the time to join us today. Over the next 45 minutes, we'll be focusing on the complex credit market. That's a sector of the wider specialist lending market, which has seen significant growth in the last 12 months, fueled by very strong customer demand. We'll explore what's fueling that demand, why the big high street lenders continue to see some customers as unlendable, and how you, as mortgage brokers, can ensure that you are best placed to support these customers. But let me start by explaining what I mean by the term unlendable. Customers are often branded as being unlendable by high street lenders, influenced by their automated decision-making systems, which can make sweeping judgments of a customer by simply looking at their credit score. However, in many situations, we believe these same customers are entirely lendable, often having suffered an event in their life which has caused temporary financial challenges. This can be a consequence of ill health, reduced income, relationship breakdowns, or any other unexpected event which causes financial distress. Once customers have recovered from these events and have their lives back on track, the impact on their credit profile can remain for many years, which often results in customers being classed as unlendable. The term unlendable describes how these customers are often perceived by both themselves and some lenders, not because there are no lending solutions available to them. Complex credit lenders, like Bluestone, are expertly placed to take a holistic view of these customers' circumstances and give credit where credit is due. This holistic and pragmatic approach to underwriting has enabled Bluestone to help thousands of customers to buy their dream homes, and we are very proud of supporting customers who are disenfranchised by the mainstream lending community. Events of the last 12 months are fueling a significant increase in demand from consumers for support from complex credit lenders, where the unexpected pandemic has impacted their lives, and by the look of it, James's hairstyle. COVID-19 has impacted the lives of so many, whether through unemployment, reduced working hours, or loss of business. Whilst the government has offered a temporary financial support to those affected, the true cost of the pandemic is still unfolding and will continue to do so for many months. The financial shock of the pandemic has, unsurprisingly, caused some borrowers to fall behind on their payments. While some borrowers' financial struggles may be short-lived, they may have a lasting impact on their ability to get a mainstream mortgage. As your customers emerge from the pandemic, many will struggle to navigate the computer says no automated decision-making systems that the high street lenders use. But this is exactly where complex credit lenders like Bluestone can help. Understanding the solutions available through the specialist lending community will ensure that you are best placed to support your customers, both old and new, at a time when they will truly value the advice and expertise available through the mortgage brokers. Back to you, James.
Thanks, Steve. Now, before we get started, I'm going to run through some quick housekeeping notes. We have a range of sessions taking place throughout this broadcast, each with a live Q&A. So please use the question tabs on the right-hand side of the swap card screen to get involved and ask questions direct to our solo speakers and panelists. You can also use Swapcard, the platform you are using, to view the content. If you have any problems or questions throughout the broadcast, please use the chat function to ask for help, and one of our assistants and the team will be able to help you. And last but not least, use the hashtag FSE TV. We'll be back in 5 minutes for the panel discussion on breaking the unlendables mould. Welcome back and welcome to the first session today, and welcome Steph and Rob. This session we are going to focus on the growth in complex credit lending and the challenges in determining affordability, taking into consideration the individual circumstances, utilising open banking and working across industries, and how brokers can ensure they are well placed to support customers emerging from this pandemic. Steve.
Thanks, James. So first question, Rob, I'm going to fire it in your direction, if that's okay. How do you think the complex credit market will evolve over the next 12 months or so?
Well, that's the $1 million question. Thanks very much for a really nice, easy start.
I thought I'd start with you.
Okay, great. Well, look, first and foremost, let's just establish that we've had at no point, certainly in a generation, a previous 14 months like we've just had. So we are in the cusp of something really, really interesting when it comes to complex credit. And I think there are so many bits of micro market activity that have happened in the last 14 months that any intermediary that doesn't support and work with a specialist lender like Bluestone right now, right here, is going to really miss out on the many, many opportunities in the next year. I mean, this is, let's not overstate this, but I'm going to. This is bonanza time. This is a massive, massive opportunity where the disenfranchised are going to come back into the market if they know there's a lender or a broker that they can work with. So it's a great, great opportunity. I can't stress that enough.
Cool, perfect. Thanks, Rob. Steph, any thoughts?
Yes. So I think I agree with Rob. It's I don't want to use the word unprecedented. I thought we were probably all hoping we could get away with not using that word today, but I know. So, but it has been unprecedented times, and I think what we don't know yet is what does the future hold. I think we just think we've got a plan and then everything changes, and I think that's the same for consumers. So the forecast for unemployment numbers is now looking lower than we initially expected, but we don't know what's going to happen. You know, when furlough ends, government measures come to an end. So actually, I think, you know, what does that customer look like going forward? And we've seen customers have a lot of help with payment holidays. Yeah. And actually, what we don't know is, you know, a lot of people have started paying, but we don't know what's happened to the customers who won't be able to pay going forward. And I think, yeah, I agree with Rob. You know, for advisors, now's the time to make sure that you help those customers. Yeah. Because, you know, there's real innovation needed there.
That's a great point. I think it's been a fascinating, I mean, customers generally, I think, will have sat at two ends of the scale almost on this over the last 12 months. Of those customers who, we know that retail deposits and savings are at record highs, but equally there will be people who have really struggled over the last 12 months. And I think as those support systems and facilities that have been rightly provided by the government start to fall away, that's when we'll start to see the true impact of the pandemic and understand the scale of customer demand for the support in the complex credit market, which will be fascinating. Thanks very much.
Steph, what impacts has COVID had on the specialist lending market?
Wow, well, what a 14 months. If we go back, we cast our mind back to March and April last year, actually the specialist lending market looked in a very different place. You know, a combination of, you know, operational capacity around, you know, automated valuations and the ability for a lot of specialist lenders not to be able to do automated valuations, payment holidays, and the impact on a lender's ability to, their P&L and their forecasting. And, we had a market where actually there wasn't an awful lot of specialist lenders in the market. So I think it's been a very interesting 14, 15 months. And actually what we thought perhaps in March and April last year actually didn't turn out to be true, which is fantastic. And that's definitely the way we wanted it to be. So I think, we've had a fantastic 14, 15 months, and that's only going to continue now, actually.
Good. Rob, same question. What's the what's happening, do you think, in the specialist market? The big impacts of COVID.
So there's definitely, I agree with that. There's definitely a twin track market now. There is the mainstream market, which is dull, uninspiring, uneventful, under attack from lenders direct to their proposition. That one hasn't gone away. And then there's the specialist market, and this has given the perfect storm for the specialist market to really do fantastic. And and thank goodness for the specialist lending market in the UK over the last 14 months, because kind of where would we be? What this is doing, to fear of repeating myself again, is it's turbocharged the environment now where specialist lending is no longer a byword for doing a bit of niche, doing a few customers. Okay. This is really massive. If you look at the quantum of the amount of people that are in this area, it's many, many millions of people in the UK. It's a huge number.
And the direction of traffic's only going in one direction, right? Is the point. So that trend will continue. I mean,
sure.
Sitting at the top of the Bluestone mortgages business, the last 12 months, I mean, it's been a roller coaster, right? So just thinking on COVID in our world, it's some of the challenges we've dealt with in terms of implementing mortgage payment holidays that didn't even exist in our business pre-pandemic, and the speed at which we had to bring those forbearance measures to market was just incredible. So working through that and then coming out of it, and ever since we've emerged from that first lockdown, seeing business volumes that have never once been below pre-pandemic levels. So we've always sat above that pre-pandemic level, showing, just as you were saying, Rob, that growing demand from consumers for the support of lenders like Bluestone and other complex credit lenders. It's I echo your comments completely. I think it's exactly right.
What do you guys think that advisors should be doing to prepare for the expected rise, obviously, in the complex credit borrowers?
Well, I'll take that question if you don't mind, James, first. So, look, the great news here is we're not talking about something really complicated or dangerous, like, I don't know, equity release. There'll be loads of equity release advisors saying it's not dangerous or complicated. But let's use that as an example, right? This is really straightforward. This is just a mortgage, another type of mortgage for slightly different type of borrower that are elsewhere. So just learn, speak to your lender representative, go on to various publication webinars. And the great news is, right, if you get a client that you can help that's in this position, they will talk to other people in their community, and you will generate the most amazing, large, loyal, zero cost of acquisition client base. So that's where the opportunity really is.
Yeah, I'm just going to jump on that comment, because we hear that from the brokers that we deal with every day in, day out. They talk to us passionately about looking after a customer at that point when they're at their most vulnerable and in need of real support and care and attention. If you harness the customer at that point, they'll be loyal to you as an intermediary and a broker throughout their financial life. Yeah, agreed.
Sure. Steph?
I think the one piece for the specialist market, which is different to mainstream, is the amount of education that's out there.
There is.
Look at today in the session that Bluestone are hosting today. There's so many, as Rob said, so many webinars. Really educate yourself. Step outside and say, do you know what? I don't do this business very much day to day, but I'm going to learn. So then when a customer like that does come along, you've got the solution. You've got an opportunity. You recognise that opportunity. I think also there's a lot of support as well. So there's businesses like Rob's who can help support you as an advisor if you're not, if you're not as comfortable, as confident. There's mortgage help desks that can help you with placing your inquiries. And there's criteria tools out there. So there's so much to help guide you. And as Rob said, I totally agree. If you've got a case, speak to a lender BDM. Just chat that case through, and then actually they'll help guide you. They'll hold your hand through that first case, and you'll actually place it right first time.
Definitely. And that's the important thing as well. Good always does come from bad. And if anything, things like this has fast tracked. It really has. And it's not just event media companies like FSE Media, but the likes of Rob. I know you've got your own channels, and SBG, I'm sure, have got the same. So it's really helped. I think everyone's come together, which is great. It really is good. Steve.
Sorry, James. I was going to say, I think one thing we often, this may be a perception, so feel free to tell me I'm wrong, but one thing I often pick up on is that amongst some members of the broker community, there's a fear of utilising or dipping into the complex credit market or using lenders like Bluestone. Where do you think that kind of comes from, and how do we as an industry kind of overcome that so that all of these customers who are finding their way to a broker come out of that with a solution that's appropriate for them?
I think you're right, actually. First and foremost, I would agree with the point. I think it probably goes back a bit of legacy into 04, 05, 06, 07, when a lot of the non-conforming subprime lenders were uncaring American investment banks that would turn you over if you missed a payment, or you'd start off at 4% and you'd end up paying 7%, and then you had, under the sort of ambulance chasing culture, potentially a PI claim. But look, the good news is those days are gone. You're not an uncaring American lender, you're an uncaring Australian. Oh, that was a joke, don't worry. You guys and the rest of the market are fantastic to work with. And look, the good news here is that just give these lenders and these clients the opportunity to get on the housing market, please. That's all I ask. Just give them the chance. These people haven't got 4 heads or 7 arms, or they're just normal people with a story. It could be something totally normal to any of us that have happened to them, a life event. They just need a chance. And if we don't give them that chance as intermediaries, I'm not sure why we're doing this job, actually.
Yeah. And it's that life...
Right.
Sorry, Steph, go on, I'll come in.
No, I was going to say, actually, there's a different dynamic to that as well, actually, which is, do the customers even look for the help to begin with? So actually, do customers even approach a mortgage advisor? Because actually, they might have gone to their high street bank, been turned down, no, maybe looked at their credit profile, looked at that big scary number that doesn't look very, very healthy, and actually then don't even think to take the approach to to speak to an advisor who perhaps probably would be able to help them. So I think actually there's a stigma, the perception and stigma in the consumer environment before we even step into advisors.
I think that's a great point. I think there's a signposting issue there, which I've kind of talked about in the market before, that there'll be a wealth of customers who will find their way into mainstream lenders who have struggled or had challenges, and or as Rob called them, life events, who for whatever reason don't meet the criteria or can't be provided with a solution by those lenders. And I think there's a real challenge to make sure that those customers are signposted appropriately, so they leave those environments understanding that isn't the end of the road for them, and there's alternatives available in the marketplace through the intermediary community. And there's something I'm quite passionate about, is kind of leading a charge to make sure that signposting activity is as robust as it should be. Just to pick up on Rob's point, you were talking about life events, which I think is, something that we as a business at Bluestone, myself personally, I think we're really passionate about that piece, because for me, that's the moral argument here, that you've got people who, and to use an example, I was listening to a customer story the other week about a customer who was working full time, managing everything perfectly, would be squeaky clean to any lender. Unfortunately, was diagnosed with cancer and didn't have the appropriate protection in place. There's a lesson there for all of us, but as a consequence of that, found themselves in real financial difficulties. As recovered, back to work, everything back to normal, and as they stand there today, there's no credit risk with that borrower. It was a life event that derailed them completely, but because of the impact that had on their credit profile, that will significantly impact that individual.
And what right have we got to look down at someone like that, or at all? I mean, let's be perfectly blunt and honest here. None of us know what the future holds, and long COVID. Who'd have heard of long COVID? 14 months ago.
Yeah.
That the NHS waiting list for cancer care at an all-time high now. So these life events are going to get magnified in number due to COVID.
Do you think the pandemic will be an equaliser on that, though, slightly? Do you think actually, because we've all been, the COVID and there's lots of extremes on that,
sure,
will have equalised everybody to us. So we've all been through this. So actually, customers, have we taken away some of the stigma in that lots of customers have taken payment holidays who perhaps wouldn't have done before, and perhaps are talking about that and talking to friends and family about it more than they perhaps would have done before?
Yeah, maybe. I mean, I think, when you're told that people like you can't have home ownership, once you believe it for good. And if you're surrounded in communities that don't have home ownership, or are in not great places, then you start to believe that. So that's the thing. We, call to arms, mobilise, make sure that we enfranchise as many as we can, get the first followers to do it, because they'll get the message about. I mean, my best ever client, many years ago when I was a broker, when I had long hair like James has got now.
That was a long time ago.
Yeah, that was a long time, and James wears that really well for a 50-year-old. I had one client in a particular road in the port town of Tilbury, and I did her right to buy mortgage, okay? And every month she recommended me to at least 15 people that I did at least 12 mortgages for. I paid zero for that. And that's, your advisors will be telling you that now, right?
It's a great example of that loyalty point we were just talking about, right?
Yeah.
They want to kind of share that with you, and that's great.
Steph, what challenges do you see brokers facing in determining affordability for complex credit borrowers?
If I'm honest, at the moment, I think the constant fast pace amount of change in criteria. I think, there's lots of lenders changing what they'll accept around bonuses, commission, overtime. Well, how do they look at furlough? If you've got a self-employed customer, how are people viewing last year's accounts? If there's a decrease, are you taking an average? I could give you a whole list of examples, and I think that's probably one of the biggest challenges, is what actually goes into that affordability and how will lenders view that. So if I was, I'd take my hat off to them, because if I was a broker at the moment, I'd be saying that's complex.
Do you think that challenge is more significant in the specialist lending market than the mainstream at the moment, or is that a broader market issue? I'm
going to make a statement. So I think it sits across the piece, actually, as across the market as a whole.
Sure.
And there's lots of, as I said, there's lots of support there to help advisors, but it's changing on a daily basis, and it's changing for the positive, because lenders are moving back towards pre-COVID criteria, and that's great. But yeah, trying to keep up with that with the number of lenders in the market, I think that's a challenge.
Okay. Rob, anything to comment on further on there?
Where'd you go after that? You've taken every bit there. You've left nothing for any of us there.
Sorry.
I'll come in with one comment. I think so. I echo your point around. I think there's a challenge with across the market. I can understand why that's a challenge, but I think it's another example of where complex credit lenders and specialist lenders can come in and be a little bit innovative and a little bit nimble in terms of the way that they're approaching customers. A great example being self-employed borrowers. How many self-employed borrowers over the last 12 months are going to have taken a dip in their income because of, again, the circumstances that we've all been trading through and the restrictions that they've had to operate within. And ourselves at Bluestone, and I'm sure the lenders will look at how they can support those, but certainly from our perspective, we've already come out and talked about how we can support borrowers who have returned to those pre-pandemic levels of business for a period of 3 months, and then see that as a way of demonstrating affordability on their pre-pandemic earnings. Because if we're expecting those customers to wait 12, 18, 24 months to re-demonstrate their affordability or that their business has returned to that level, then again, that's going to create a huge cohort of customers who will struggle to secure finance in that intervening period, which would be a great shame.
But the specialist lending market is entirely owned by UK intermediaries. That's the great news, right? That's the great news, that these customers aren't going to Santander or Halifax or any other lender out there. Other lenders could be considered. Any of those at all. These are intermediary-led and owned advice clients.
Absolutely agree. Absolutely. Steph, customer circumstances are becoming more and more complex. How can brokers ensure they are given the right advice that takes their individual circumstances into all the account?
I think that's what advisors just do. I think that's the true value of an advisor. To sit and talk to the customer, get a full view of their past, their present, and their future. What are they looking to do? What's their lending borrowing aspirations, and then knowing where to place that, knowing how to help them, guide them, support them through. So, to me, that's the value of advisors. And as Rob said, the specialist market is. I
guess it's a thorough fact find, obviously, and making sure that you're knowing your customer from the outset.
And you're paying a broker for success, right? When you go into a bank or a building society, you're not paying the broker to do their job because they're getting paid. They're not really getting bonus. You go to a mortgage intermediary, and you are paying for a service that is almost entirely paid on results. So that's kind of the main point, and we forget about that. It's just a real simple piece of economics, that if you're paying someone for a service they're likely to work a bit harder and likely to get you what you want if you're going to get paid for it.
Yeah, they're very correct. I'm just conscious of time. So there's one question I wanted to get in was around vulnerability. So customers who perhaps have had some financial challenges or what might be deemed as adverse kind of credit in their background would often be deemed as being vulnerable. So Steph, perhaps if I fire this one at you, what should brokers do to ensure that they're treating those customers appropriately if they're meeting the definitions of being a vulnerable customer?
So I think, you know, it's important for mortgage advisors to recognise those characteristics and help and support and guide customers through that. I think there's definitely an element of, you know, just because a customer's got vulnerable characteristics, and as you said, financial is, you know, maybe an adverse situation, lack of financial resilience. But I also think, you know, that doesn't mean that they can't be helped through. It doesn't mean they can't have that level of borrowing. It just means they need more time, patience, guidance, support to make sure they're making the right decisions. And again, that comes back to the true value of having a mortgage advisor. It's not just on the mortgage advisor, I think it's everybody within that chain to help identify those pieces. And the pandemic will have had an impact. The FCA's financial life study last year showed that a higher proportion of adults will have been impacted by COVID. So, you know, vulnerability is there. We're talking about it more though as well. I mean, so yes, you know, unfortunately the characteristics and that trend is increasing, but we're raising awareness. We're talking about it now.
Absolutely.
That's really important.
Absolutely. And we work very closely with you and other intermediaries through the market we almost rely on you to identify that vulnerability at that early part of the advice process, and then bring that into the transaction that we, as you say, all individuals along that journey, from the point of advice to when that loan's settling, and actually then transitioning into the lender as part of the life management of that customer, that we're all aware of those circumstances and can provide that tailored support that the customer will need.
That comes back to that personal support that the advisor can offer.
Exactly.
And your products are often a recovery route. Your products are often the way that normal clients that have had a life event get back to the high street over a period of time. So again, not only is it an intermediary-led sell, but it's an intermediary-led refinance as well. I'm sure you've got a retention proposition that's wonderful and people would stay. But again, it could just be a route, couldn't it?
Absolutely, absolutely. Guys, unfortunately, I can't believe that's been 20 minutes already. But thank you both for joining us. It's been incredible. I hope that the audience got a lot out of that. And that's all we took at time. So we'll be back in a 5-minute break with Robert McKenny, who will take us through the complex consumer credit behaviour. Thank you very much. Welcome back. We are now joined with Robert McKenny from Equifax and the power of technology, live from the studio here in Westminster, and Robert from home. Robert, welcome.
Thank you.
Good to see you. What, Robert, are the kind of credit risk holes that lenders are seeing now, which makes scoring complex credit so hard?
Yeah, so to be honest, a lot of them relate to the pandemic, if I'm being honest. So with the pandemic, the regulator very early gave out guidance that people can take a payment holiday up to 6 months and it won't be adverse to their bureau insights. So we didn't receive updates that suggested a customer had missed a payment. Or told us that customers had missed a payment. So for all intents and purposes, all customers are continuing to make payments and everything's ticking along okay. That's fine for customers who have made a conscious choice to say, I might be having some financial difficulties, or I might want to get ahead of some financial difficulties. But if you take a score from Equifax or any bureau, it looks at the past performance of your credit. If it's not showing anything adverse, then your score is going to be unaffected. So that's not a bad thing. It's what the regulator wants to do. However, within that, there will be some customers who are probably on the cusp of having financial difficulties. As such, is a lending decision right for that customer? So a number of clients are looking at, okay, how do we make that better informed decision? So forbearance is one area that's an issue, and the other one, and it was talked about in the last session, is furlough. So customers who have been put on reduced earnings, what's their true earnings? How do you get to work out affordability? Because certainly from any lender's perspective, they're looking at both a combination of score, are you a good risk, are you likely to pay back, and affordability, can you afford to meet the repayments when they come due? It's both elements of that. And with COVID, both of those, for certain segments of the population, have been affected. And it doesn't mean you're a bad risk, doesn't mean you're a bad customer. It's how do you make that well-formed and well-intended lending decision. So those are kind of the big areas that have kind of presented holes for lenders, that they've had to kind of look at their credit policy and understand, right, what do we want to do? And for the vast majority of lenders, a lot of them kind of reacted by going, right, scorecard cutoffs are going to go up. We want to be risk averse. We want to make tighter on affordability, so we want to make the thresholds a bit tighter, and therefore it's probably been a little bit difficult in the past period to go, right, has that gone too far? Far enough? Is there more that things can be done to make sure you're giving the right lend to the right individual? Because all lenders, they have to be responsible in their lending outlook, and they have to take the information that they have to inform that decision making. So those are probably the two biggest areas that have caused issues today, and that's rippled through not just your consumers, but your self-employed as well, because everybody through the pandemic has been affected.
Thank you. Steve.
Thanks, Robert. I mean, it's a great detailed answer. So just I want to try and explore that from the concept of unlendables a little bit as we're talking about here today, and you were talking about that credit scoring piece. And lenders utilising that kind of platform or that intelligence to make a judgment and a decision in terms of whether or not they'd like to lend to those. In a market where obviously some customers will have had short-term impacts on those credit profiles, which might have impacted the score. I'm just trying to think back from a consumer's perspective. How would they? How can the credit reference bureaus and the market that you operate in help direct and steer those customers to a solution where their credit score might have been materially impacted during the pandemic?
Yeah, to be honest, the start point is understanding your credit score, understanding your credit file, what's contained within it. Is it an accurate reflection of you as an individual, the payments you know you've made or you've not made? Is there anything in there that you believe is incorrect? We obviously receive that data from all of our clients. We compile that and then we generate your credit report. That credit report, individuals can source directly from us. You can go to any of the providers that are in the marketplace just to see what's it telling me. And you should look at it, in my opinion, on a periodic basis, just to make sure there's nothing untoward. And certainly if you're thinking about getting a mortgage, you should be preempting and going to look at your file. I would also say now with the likes of open banking, your bank account and the content within it is also an area you want to look at and kind of pre-position yourself before applying for a credit. You know that you're in the strongest position possible, whether that's for mortgage or any lending in particular. So my guidance would be get your credit file, check to make sure it's got everything there that you expect to be there. If there are areas that are not, you can either come to your bureau or you can go back to the lender directly and say, I don't understand what that is. And there's a 30-day timeline for that to be looked at, investigated and addressed. So there are ways you can do it, but you should never be surprised by what's in your credit file. In terms of the score itself, again, for Equifax, we create a score, we can make that available so you can see what your score actually is. However, lenders also take that score and other inputs and create their own score. So it's not always the same 100% with all lenders, because every lender has their own risk appetite. So it's not a blanket, that score means I'm always going to be approved, because that's kind of the factor. And certainly in lending terms, you go, I'll check the score, I check affordability, I'm going to look at the loan to value as a lender, and I'm going to check to see whether there's anything adverse that might go, actually, looking at that and that in isolation, it's enough for a lender to go, I don't want to lend. So that could be county court judgments, anything typically quite serious, high number of defaults where you've not made payments. Now, those defaults can be for reasons like I'm in dispute with a supplier and they start to say, well, I've missed the payments. That can appear in your credit report. But again, you should know that, you should understand that, and you can put notes in your credit file to say, that's for this reason. And anything like that has to be looked at manually. So there's a number of things as a consumer, you can look at your credit file, you can understand it, and then, as I say, I would say, make sure it's okay and there's no surprises within it.
Great, thanks, Robert.
Robert, in layman terms, what would Equifax suggest an intermediary says to a complex client who thinks that they might not be?
If they believe they're a complex client, it's back to walk through, and I think the last session kind of covered that, is the intermediary will be packaging that case. In other words, they're going to have a good understanding of that customer's profile, their employment background, their spending patterns, their credit score. And it's that kind of combination of circumstances that you go, well, let's look at that and go, is it really complex? Yeah, you're going to have certain situations like first-time buyers. They might have thin credit files. Therefore, it might look like there could be a higher credit risk. But that in itself is not necessarily the case. So it depends on the definition of kind of complex. So I think first-time buyers, it's always a bit more difficult for sometimes a first-time buyer if they have got that thin credit file. So I would certainly say anyone in that boat, try and make sure your credit file has credit. It sounds quite simple, but you should have credit. You should show that you've been managing credit, repaying credit, and that means you're in a good place. If it's a situation where they say, I don't understand why there's a missed 3 payments, I don't think I've missed 3 payments, then it goes back to understanding why that's been reported. Errors can't happen. I don't think it's a common situation, but they can happen. So therefore you should go and say, why is that there? Can I get it fixed? And therefore make the case that much better. Affordability, and again, for individuals, people sometimes I find get confused between scoring saying no and affordability. They are 2 different things. They're linked, but score says the likelihood I can make payments, that's what scoring's doing, versus I can actually afford to repay it. So you might come in and say as an individual, but I've got lots of money, I can afford it. You go, yeah, technically you can, but we can see in your bureau file you've missed X, Y, Z payments and you've got a history of doing that. Together, both things have to be positive, and that's what makes the difference when it goes into a lender to say, yeah, and we'll happily take on that risk and that assessment. So, and similarly, people might say, I'm a bit tight in affordability, but I'm a good credit risk. Bottom line right now is if you can't afford it, lenders are not going to provide it because they've got to be responsible in their outlook. So it's got to get both sides of the equation right and take it forward.
Thanks, Robert. One quick question that's coming from the audience. Why is there often a difference between, or why is there sometimes a difference between the data that shows on Experian and the data that shows on other credit reference bureaus that brokers might typically use and lenders might typically use during the mortgage process?
Yeah, so each bureau does have its own matching algorithms of how it pulls in data and then matches it up to be Robert McKechnie in this case. So we do it based on the rules that we've developed over the years, and Experian do it slightly differently, and TransUnion do it slightly differently again. Typically, all bureaus have the same data. There can be slight variations between the data content in that, I don't know, Experian might have a little bit more rental data compared to ourselves, for example, but fundamentally we all have pretty much the same data. So it does come down to the matching of how we match up. Now, so in some places, for example, and I'll use Scotland because that's where I'm based, you've got first floor right flat or second floor left flat. That can be problematic because it's how you match up me to that address and therefore the data that comes in. So again, goes back to what I said already, if you do believe your credit file's not got everything in it, then yeah, look at it. But 9 times out of, well, I would say more than that, 99 times out of 100, you're going to find the consistency between the files. It could also be just a timing of when the files come in, are loaded, and then it appears. So that can drive a little bit of a variance. But again, you're probably talking around the edges. It's, I would say, probably marginal in terms of how significant it's going to be. Because normally speaking, in any credit scoring, you're taking a balanced view of what's happening in that customer. Yeah, if it's a county court judgment and you've got a rule that says 2 county court judgments decline, that can be enough to tip you from a yes to a no.
Got it.
But that's kind of what we find.
That's great. Thank you.
Robert, thank you so much for joining us today. Unfortunately, again, we've run out of time. So up next, we've got our presentation given by Rhys Beddle, who's the Head of Sales and Marketing of Bluestone Mortgages. Welcome back, and joining us now is Rhys Beddle, the Sales and Marketing Director at Bluestone Mortgages, who I'm pleased is taking some of the flack from my hair with this moustache he's recently grown. Rhys, what are you here today to tell us about?
James, I was just about to compliment you on your hair, so thanks for bringing up the moustache. I'm going to take that back, actually. Today, I'm going to be talking through some of the Bluestone clients you would have seen earlier in the broadcast. Some of them that have been deemed unlendable on the high street.
Why did the high street lenders have an issue with Gerald's application?
So Gerald here. So Gerald is a self-employed musician with his income, as you can imagine, being heavily affected by the COVID-19 pandemic. First 6 months of the pandemic, Gerald was unable to perform, as you can imagine, and subsequently had no income coming in. He was living off his credit card. His credit card later defaulted as he couldn't make minimum repayments. This affected his latest SA302s, as you can imagine, with Gerald having a significant reduction in salary from his 1920 SA302s.
Okay, so how was Bluestone able to help Gerald?
So over the winter, Gerald started selling his music online. Son-in-law helped him out to several companies. This became very profitable for Gerald, and he actually increased his income. So his income actually went back to pre-pandemic levels. And at Bluestone, we were able to use Gerald's 1920 SA302s for affordability, as we could see that Gerald's current figures were in line with his 1920 accounts. The default wasn't an issue, as it was caused by a life event and was registered more than 6 months ago. At Bluestone, we can allow up to 4 defaults in the last 3 years, as long as there's none in the last 6 months.
Now we move to Jane. So what's some background on Jane?
Well, this is Jane. She is a recent graduate. She's a mature age student who's just finished her marketing degree. She was lucky enough to start her first full-time role straight out of university at one of the placements she did during her days at the university. After 30 years, her parents had finally had enough of her living at home and actively encouraged her to purchase her first home.
And why was Jane not able to get a mortgage with one of those high street lenders?
Look, there's a combination of reasons that impacted Jane's ability to get an approval on the high street. Firstly, her employment. She was only been in her current job 6 months with no demonstrable working history. During her university days, she'd maxed out on a couple of credit cards. This affected her credit score, which meant she failed the minimum credit score requirements of some of the high street lenders. And finally, Jane had no personal savings. So the minimum 15% deposit that she needed, she was solely relying on the bank of mum and dad.
And how was Bluestone able to get Jane onto the important property ladder?
Glad you asked, James. Big thing for us is we don't credit score. So it's something we pride ourselves at Bluestone. We don't credit score, and we manually look at every application by its merit. Jane fits our minimum employment requirements. We only require an applicant to be in their current role 3 months or 6 months continuous. And on the deposit side, we can allow 100% gifted deposit. This is perfect for those first-time buyers in similar situations like Jane here.
Fantastic. Reece, thank you so much.
Thank you, James. Appreciate the kind words.
Thank you. Welcome back, and thank you everyone for being part of the audience. And most importantly, Steve, thank you so much for supporting today. Interested to find what you feel was your favourite part of the whole broadcast.
Well, firstly, I think it's been a great afternoon. So thank you to FSE Media for hosting it. It's been fantastic, and thank you to Rob, Steph, and Robert for joining us and making the event so worthwhile. I think for me, it's just been great to hone in for 45 minutes to an hour on what I see as a really growing and emerging part of the UK mortgage market. One that I think, as we've all heard here today, particularly in the panel debate around how we expect that opportunity to continue to grow and accelerate over the coming years. And the great content that we've heard in all of the sessions that just kind of emphasises what's influencing that growth, how brokers can embrace the opportunity, utilise the training materials that are available and engage with specialist lenders to make sure that they're well placed to look after those customers as they emerge from the pandemic. So if there's one lesson I think that brokers could take away from today, it's about when those customers land in front of you, be confident that there are solutions available for them and knock on the door of lenders like Bluestone, and we'll do our very best to help.
Fantastic. And I think if there's ever a worry about your MD position at Bluestone, I think there's potentially a TV presenting career
my hair that long, though,
for both of us. And I
that's the problem.
Just heard from the floor manager, actually, I think Anne and Dec are pretty nervous after our sessions. But Steve, thank you so much.
James, it's been a pleasure.
It has been. Thanks, guys.
Cheers.